We're talking all about how you can pay 0% in capital gains tax when you sell an asset like a stock or an ETF. You do not want to miss today's episode. If it's your first time here, my name is John Boyd. I'm a certified financial planner and I'm the founder and lead wealth advisor at Modern Wealth. That's modern spelled with no vowels, wealth. We're a fiduciary fee-only financial planning firm located in Scottsdale, Arizona, but we serve clients all over the country. We do it all from tax planning, estate planning, investment management, and more. And I'm so glad you're here today because we have a good one for you. So let's say you bought an asset like a stock, right? You bought a stock, you've held on to it for, call it 6 months, and you've made $1,000 on that stock. When you sell it, you'll have a $1,000 capital gain. Now, because you sold it prior to owning it for over a year, right? You've only owned it for 6 months. Because you sold it with that type of ownership period, you are going to have to report that $1,000 as ordinary income tax. However, the IRS rewards you for being a patient investor. So let's say that you held on to that stock for over a year and then you sold it for that $1,000 gain. You would be eligible for what is called long-term capital gains. And long-term capital gains are generally taxed at 15%, which is a lot better than paying ordinary income tax. However, there is a way that you can legally pay 0% in long-term capital gains tax when you sell an asset and that would allow you to completely avoid paying any taxes on that transaction. So let's go ahead and break down how this works. So what you're looking at are the long-term capital gains brackets for 2023. So if you are a married couple filing a joint tax return and your taxable income is below $89,250, then your long-term capital gains rate would be 0%. Now, I want to highlight taxable income, okay? Because this is huge. This is really, really huge. Because taxable income is not the same as gross income, right? Taxable income factors in all your 401k contributions, HSA contributions, and this is what's really big. It factors in the standard or itemized deduction. Whichever one you take, that's also factored into the equation. So after you factor all that in, that could greatly reduce your income. So let's go ahead and take a look at an example. So let's go ahead and say that your gross income is $150,000 and you're married filing a joint tax return. Let's say that your 401k contributions combined are $40,000. You also make HSA contributions of $7,750. And you elect to take the standard deduction, which in 2023 is $27,700. That brings your taxable income to $74,500. Now let's go ahead and take this a step further. So your taxable income is $74,500. But let's say that you bought 100 shares of XYZ stock at $10 a share on January 1st, 2020. So your total acquisition costs were $1,000, or your cost basis was $1,000. Now, 3 years later in 2023, you sold those 100 shares at $50 a share. So your total sale proceeds was $5,000. Because you held this stock for over a year and you had a $4,000 gain, that means that you will have a long-term capital gain of $4,000. Now, here's what's important to keep in mind. That $4,000 long-term capital gain, for the purposes of this calculation, will bump up your taxable income to $78,500. Now, let me go ahead and refresh you on what the long-term capital gain brackets are. If our taxable income is below $89,250, then we will pay 0% on that long-term capital gain. So in this case, we completely avoided paying any taxes on that transaction because our taxable income was below $89,250. Now, I want to highlight the fact that the long-term capital gain increased the taxable income for the purposes of the calculation. The reason why that's important is that you get a lot of people who learn about this and they think, well, my taxable income is, call it $80,000, but I have a $100,000 capital gain I'd like to take this year while I'm in the 0% bracket. You are more than welcome to take that gain, but keep in mind, when you do that, that will drive your taxable income up into that 15% tax bracket. So on that $100,000 capital gain, you will pay 15%. Okay, so that money, although it's taxed differently than your ordinary income, it does get factored into that equation. So keep that in mind. But if you are aware of all that and you're aware of the brackets associated with this, you could potentially avoid paying any capital gains whatsoever on your stock, ETF, mutual fund transactions, and more. So really cool stuff, right? So what are the 3 considerations that you need to keep in mind if you want to deploy this strategy? Number 1, you want to keep in mind what are your short and long-term capital gains. Okay, so go through your portfolio, see the assets that you've held for over a year, see the assets that you've held for less than a year, and check what your gains and losses are. If you have assets that you've held for over a year, then you know they're eligible for this strategy. If you've held them for less than a year and you have short-term capital gains, then you would not be eligible for this particular strategy. So keep that in mind. Number 2, you want to keep in mind what deductions you have. So let's say that you're just on the brink of being eligible to make this strategy happen, but you're not making enough 401k contributions. Maybe go ahead and modify your 401k contributions so that you can reduce your taxable income so that you can make this strategy happen. Again, be aware of your deductions in different areas, whether you're bunching deductions, taking additional 401k contributions, whatever it is, because that is going to be critical in determining if you are going to be eligible for this particular strategy. The third and final consideration I want you to keep in mind is think about tax gain harvesting. Most people are familiar with tax loss harvesting, where you intentionally incur losses to reduce how much capital gains you would have to pay. But I would argue that if you have taxable income that is low enough that would warrant you to take gains, then I would explore actually taking gains and taking chips off the table during this period. This can be a fantastic strategy when you have conditions like this year where markets have gone up significantly. Maybe it makes sense to de-risk the portfolio and you have gains across the board. Maybe you go ahead and take gains off the table while you know that your long-term capital gains bracket is at 0%. So I hope you found this helpful, guys. If you guys want to incorporate this into your own tax plan and you need help, reach out to us, www.modernwealth.com. That's modern spelled with no vowels, wealth.com. I hope you learned a thing or two here, and we'll see you next time.